4 huge dividend increases. We're going to run through them today. You know the process. We're going to take a look at these companies, their historical performance. We're going to take a look at their dividend safety. We're going to take a look at their financial metrics. And as always, we will run them through our valuation model, getting to what we believe the intrinsic value with our acceptable price and that margin of safety. We'll also take a look and see what Wall Street are forecasting as their price target over the next 12 months. So let's jump into the first stock. It is Broadcom with their dividend increase of 14% just a few weeks ago. Now, over the last year, it has had a phenomenal run, up 89%. It is trading towards the upper end of the 52-week range with a forward yield of just below 2% and a forward PE of just under 24. If you've been holding this company over the last 10 years, you would be up an incredible 1,917%. Now, it doesn't include those dividends reinvested, but that is absolutely phenomenal for any return on any investment. Dividend safety then is sitting at 67 safe, market cap 522 billion, a mega cap company. In terms of those who see a recession inbound, well, they didn't pay a dividend in the last recession, so no comparative data, but they did have around average growth of that of the S&P at around negative 12.7%. So dividend growth, absolutely phenomenal, 14% increase just a few weeks ago. Last 5 years at 19% on average. Last 10 years, 36%, well above that minimum 4% we advocate to get just to keep in line with inflation. And they have been increasing those dividends for the last 13 years. Let's take a look at dividend yield theory. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of overvaluation with the current yield sitting below the 5-year average. And a similar story here with the forward PE 23.5 above that 5-year average of 14.8. And we can see Broadcom is slightly lower than the sector forward PE of information technology at 24.4. In terms of free cash flow, well, we ignore the earnings. For those that are new to the channel, we do this because it is susceptible to manipulation by management through accounting. Personal preference is 60% or lower. Gives me faith that management of these incredible companies can continue to offer those double-digit dividends we love to see. 45% for Broadcom in 2023, pretty much the average over the more recent period. That is positive, and I would expect to see again in December 2024 another very juicy double-digit dividend increase. On top of that, probably one of the best for growing that free cash flow year on year. $3 in 2014, $42.50 in 2023. If you had bought a share in 2014, it would have generated $3 in free cash flow per share. If you had still held on to that share in 2023, it would have generated you $42.50. Absolutely incredible. A very strong company. Sales growth, well, 3 to 7% is what we target for steady moderate growth, but do bear in mind this has grown a lot over the real older period. Double digits from 2014 to 2016. It has started to come down from that point. Still, 8% isn't too bad in 2023, and I would like to see them go back up to double digits consistently, as this is what they have done historically. Total sales then, it has gone from 4.3 billion to 36 billion. Shares outstanding, now we love it when companies do share buybacks, returning excess cash to investor pockets. Avgo, unfortunately, they've done the opposite. They have diluted your position if you held in 2014. 267 million shares outstanding to 427 in the more recent quarter. ROIC, always an absolutely fundamental metric in my opinion. I want to be seeing 10% as a minimum. Gives me faith that management are able to effectively allocate their capital. The last 3 years, very good. 2023 itself at 26%, absolutely incredible, and I would like to see them set that as the average over the more recent periods to come. Operating margin, free cash flow margin, we can see not only is it above that 16%, but over the longer term it is in actual fact increasing, 46% in the more recent year. Same story for the free cash flow margin, above that 5%, but it has been increasing 51% in 2023, and it has been that way for the last 4 years. Absolutely incredible as an investor to see. And finally, the net debt to EBITDA, earnings before interest, tax, depreciation, amortization, As always, remember it shows us the balance sheet strength as well as dividend safety, and these show us the number of years it would take the company to pay off all of their debt net of cash on hand. 1.1 in 2023, below that 1.5. 2024 expected even lower. It has a very strong balance sheet, and that dividend, for now, based on the information we have, does look to be safe. So let's take a look at the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of videos as they drop. Now, historically, when we do our deep dives, we do run through every single one of these models to get to the intrinsic value. For today's episode, let's jump straight into the final number. So the intrinsic value for Broadcom in today's episode is $1,063. Don't forget, if you do click on that pinned comment below, you can grab a copy of the valuation model to get to the intrinsic value, as well as acceptable buy price of companies in your own portfolio and on your watch list. So margin of safety, we start off with 10%, and we can see it doesn't warrant a 10%. Now, we would use that if we believe it has a wide moat, strong financial metrics, good forward-looking data. Right now, at the current trading price, we can see it's around $30 to $40, so not too far off the current price. So we believe that Avgo is trading near enough its intrinsic value. What do Wall Street say? Well, they have a price target of just under $1,200 over the next 12 months, so they see around 9% of upside for Broadcom. Personally, this isn't one that I do hold. While it is an absolutely phenomenal company, I do hold it indirectly, however, through ETFs that I do own. So whilst it isn't one that I will own right now or directly, it is one that if it was to come down at a very reasonable margin of safety of around 15 to 20%, it is one that I would add directly to gain exposure specifically to this industry. Now, before we move on to the second stock, just to let you know that I am going to be doing a free weekly newsletter once a week, running through companies that we ran through during the week, their intrinsic values, doing some deep dives specifically in the newsletter, and talking about some important metrics that I do look at when investing. If you want to get access to these free newsletters that do come, do click on that pinned comment below and sign up to these subscriptions, which is completely free. So let's jump into the second stock, which has had a very strong dividend increase. We're talking about Mastercard Corporation with a 16% dividend increase over the last few weeks. It is up around 14% over the year, trading again towards the upper end of the 52-week range, a yield of 0.62% and forward P of 35. If you've been holding this over the last 10 years, you would be up 445%, although do bear in mind it doesn't include those dividends reinvested. Dividend safety, 99, very safe. Market cap, 402 billion, a mega cap company. In terms of key metrics in the recessionary period, they maintained the dividend during the 07-09 crash, above average growth, and significantly outperformed the S&P with a negative 12% recession return. There we have that dividend increase, 16%. On average over the last 5 years, 18%. Over the last 10 years, 33%. Absolutely gorgeous. Imagine that 33% increase year on year. You would be laughing. Dividend growth as well. They have been increasing those dividends for the last 11 years. Dividend yield theory, then, it may come as a surprise to some people, but it does have a sign of undervaluation with both the yield above the 5-year average as well as that forward PE 31.3 sitting below the 5-year average of 33.3. In terms of comparison, we can see though these financials is sitting significantly lower at 10.9. Free cash flow payout, beautiful, in fact below 20% for the majority of the last 10 years. 2023's annual report is expected to show 22% to that free cash flow payout, so no surprises there. We should be expecting a double-digit increase this year as well. Free cash flow, well, more than 3 times over the period, $3.17 to $10.40. Slight inconsistencies year on year, but overall moving in the right direction that you want to see as an investor. Sales growth, pretty much double-digit increase every single year other than that COVID year in 2020 and 2015. So it is moving in the right direction with 2023 expected 13% to the top line. Total sales then, 8 billion in 2013, 22 in 2022 and 24 expected in 2023. On top of that, shares outstanding has been reducing. Very nice to see. 1.22 billion to 952 million. So this is also returning excess cash to you as a shareholder. ROIC, I mean, phenomenal, blows every other company out of the water. In the mid-60s, we see 71%, and their latest year expected 63%. Absolutely incredible, and this is one of the reasons why I do not care that Mastercard does pay such a low dividend yield, because their return on any of their cash is 63%. That is one of the highest that we have seen. Operating margin, free cash flow margin, similar to the sentiments shared on the previous metric. Incredible mid-50s on the operating market, mid-40s in fact on the free cash flow margin, so absolutely gorgeous. Not a lot of companies would be able to do something similar. And when we look at the net debt to earnings before interest, tax, depreciation, amortization, 2023 at 0.54 really shows us no worries with their balance sheet, zero worries with that dividend safety. So what about their valuation? Where does Mastercard currently sit? So we can see their intrinsic value for today's episode comes to $474. Margin of safety at 10%, we see it's not too far off a 10% margin of safety. And in terms of Wall Street, what do they forecast? Well, they see around 11% upside over the next 12 months. Now, this is definitely a company that tends to trade at a premium. You would be quite lucky typically to get Mastercard at a 10% margin of safety over the longer term. And this is definitely one that I have my eye on, and it would be one that I could see myself adding in this quarter in 2024. Even with a 10% margin of safety, Mastercard is one that I would be happy to purchase for the longer term, as I'm not personally, as an investor, looking to buy a company and then sell it over a year or two. I am, or tend to look at companies that I like to buy and hold. I say forever, things could change over the longer term, but that is the mentality that I do like to have with the companies I invest in. But as always, let me know your thoughts as we are going along with these companies, what you do believe, whether or not you see them as undervalued, or whether or not you even see these as long-term holds in the portfolio. We then move on to the third stock, which is Deere Co. Now, this is one that has in fact increased their dividends twice in 2023. And overall in the full year, the dividend increase was 16%. Although over the last year, we do see it down 14%. It is trading towards the mid to lower end of the 52-week range. Offers a yield of 1.53% and a forward P of just under 14. Over the last 10 years, however, you would be up a very nice 342%. Dividend safety, 83, very safe. Market cap, just over 100 billion, mega cap company. Last recession, well, maintained the dividend below average growth and trailed the S&P with that negative 65% return. Dividend growth, common with these companies, double digits, as I said, over the last full year, 14% over the last 5 years, 13% over the last 20 years. Very, very nice to see as an investor, although do note they have only been increasing those dividends for the last 3 years, as they did maintain that dividend in 2019 to 2020. Now, dividend yield theory, we see that sign of undervaluation, 1.55 versus 1.3. Forward PE, 13.4 versus 15.6, so a double sign of undervaluation. And we see the sector P significantly higher at 19.7 for Deere Co. Now let's take a look at the free cash flow payout. Well, this is one of the reasons why we say don't look at earnings payout. 2022, you'd look at that 18%, you'd be chuffed, happy with yourself. 2022 on the free cash flow, 146% means that the company's paying out more in dividends than it's generating in free cash flow. Now, I say this many times in every video, but it is incredibly important to understand that a company you're investing in, if they are paying out more in dividends than they are generating in free cash flow, it is a bit of a worry that you should keep your eye on. Positive news, 2023 at 36%, 2024 expected even lower, so there is no real worries so far based on this information. Free cash flow per share, well, $2.39 to $14. Strong growth over the longer term, but again, we do see the inconsistencies with a 3-year period of negative cash flow. Sales growth, again, you could argue cyclicality of the industry, which is fair enough. We see 2014 to 16 negative growth, followed by positive growth, and then we have that COVID year before rebounding. 2023 at 16% is very positive. And we can see over the longer term, they have nearly doubled their top line from 36 billion to 62. Shares outstanding, very nice to see. They have reduced their share count. Whilst not consistent, it is a positive, a big positive to note. They have bought back over 70 million worth of shares, nearly 20% of those outstanding over the last 10 years. ROIC, there was a period that I wouldn't be happy, but from 2021, I've seen 3 years of above 10%. So this does make me happy, and it has been increasing. So this is a positive, in my opinion, when looking at management over the more recent period. Operating margin we do see increasing over the longer term. Very nice to see that over the more recent period it is above that 15%. Free cash flow margin, it did slip in 2022. It has increased in 2023. Just something to keep an eye on. We like to see at least 5% for heavy equipment makers such as Deere Company. Net debt to EBITDA then, 1.04 in 2023, well below the 2.5. No worries with that very safe dividend, and the balance sheet seems to be okay based on this information. So let's take a look at the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So a 10% margin of safety for Deere Co. We can see 408, it is a buy, 15% a buy up to 386, 20% not quite there yet. So right now we do see around a 15% margin of safety. In terms of Wall Street, well, they see some nice upside at 18%, with a price target of $447. Now, I know there are a lot of people in the dividend community who actually prefer Caterpillar to this company, so do let me know your thoughts whether or not, when you do compare them side to side, if you still would go for Caterpillar based on the information that we have run through today. Moving on to company number 4, we have Waste Management, currently trading at $182. They increased their dividend by 7.1% over the last few weeks, and we can see they are up around 18% over the year, trading at the upper end of their 52-week range. Forward yield 1.55% and forward P of around 30. If you've been holding this over the last 10 years, you would be up 336%. And we can see that dividend does look to be safe with a score of 74 and market cap just under 73 billion, making a large cap company. Positive news, in the last recession they did increase the dividend. They also had average growth sales, but they also outperformed the S&P with that negative 40% return. Dividend growth, nice to see, above inflation increase, 7.1%, last 5 years 9%, last 20 years 32%, so very positive in my opinion, and we can see they have been increasing those dividends for the last 19 years. Dividend yield theory then, we see a sign of slight overvaluation with that yield below the 5-year average, but we do see that forward PE more in line with the 5-year average of 26.7. Industrial sector P is much lower at 19.7, with Waste Management commanding a high 27.7 PE. In terms of free cash flow payout, below 60%, and 2022 is just that at 55%, although 2023 is expected to be 67%. Not too bad, I can give some leeway with companies like this. Free cash flow margin increasing from 253 to 472. Again, we do see the inconsistencies with some drops year on year, but overall it is moving in the right direction, nearly doubling it over the period. Sales growth, whilst we look for steady, moderate growth, don't expect anything too special with this company. You will probably be getting around 3 to 7% year on year, as we can see, although we do note some strong growth in 2021 and 2022, with the latest year expected to come in at 4%, roughly in line with inflation, and we can see that growth from 14 billion to 20 billion in the years. Now, shares outstanding, very consistent year on year. They have been reducing that share count, which is always positive to see, around 10% over the last 10 years. Now, in terms of ROIC, always good to see a company that's consistently above that 10% minimum that we look for, and it makes me happy to see that 2023 they are expecting to see a 15% level. In terms of the margins, always great, especially with companies that do tend to find it difficult. Their margins are above 12% on the operating side, 18% expected to be clocked in 2023, and the same to go with the free cash flow margin, 8% in 2023, above the minimum 5%. Finally, the net debt to EBITDA, we can see 2023 at 2.6, lower than the 3. It isn't too far off that, so one probably just to keep an eye on moving forwards. So let's get into the valuation of Waste Management. Don't forget you can click on the pinned comment below to grab a copy of the model to get to the intrinsic value and acceptable buy price of companies in your own portfolio. So starting off with a 10% margin of safety for Waste Management, we see that right now it doesn't command that. We can look at a 5% and it's pretty much at that price. So we believe a 5% margin of safety for Waste Management at the current values and estimates. In terms of Wall Street, well, their price forecast is around $183, pretty much saying a very, very minimal upside over the next 12 months. Now, personally, whilst this is one I had previously considered to add to the portfolio, it just never trades at a sufficient margin of safety for me to be able to lock in prices. We would need to see at least a 20% margin of safety, which would be around $154, or even lower for me to be really satisfied to enter into this company. But as always, who knows what the future holds, where the markets will go, no one can know. But right now it is a bit too premium for me. But as always, let me know your thoughts in the comments below. Don't forget as well to click on that pinned comment below and join us in the newsletter discussions every week. Now, don't forget, smash the like button if you've enjoyed today's episode. Hit that subscribe and bell button. And as always, have a great day and catch every single one of you on the next one. Take care for now.